Hi there, Stephanie Kammerman live at the New York Traders Expo. I'm with Marvin Appel from Signal Alerts. And I love that, Signal Alert.
Signal Alert, yes.
Yes. How do you alert people when something is going to happen?
Oh, okay. Well,
Yeah,
for our money management clients, we take action. They trust us to do that. But we also publish a newsletter that my father started back in 1973. Comes out twice a month, and we have twice weekly email updates. So that's a timely way. If you want to follow our thinking, you can get it directly to do on your own trading.
Right. No push notifications to your phone? Or
No, we don't do that.
No, okay.
I mean, it would be a great idea, but then it would be a much more
so.
expensive service.
Well, yeah, but it's people want to know. We live in such a different society. I mean, I know my kids, they have no patience. They want to know, like, right now. You know, people have no patience anymore.
Right.
You get an email, right, and everybody wants you to answer them back.
Right.
If you don't answer back in one day, they're like, are you alive? Are you dead? No, actually, I was working, right? So, just let's talk about MACD and what you're seeing right now in the bond sector.
Okay.
Because they've been really getting hit.
In using MACD, I find that a weekly MACD is most effective for bonds. In particular, the 6 to 19 week MACD on interest rates or on the prices of bond ETFs, investment grade bond ETFs, for example, or for that matter, on credit quality spreads if you want to trade junk bonds based on that. All of our bond models, except for floating rate corporate bonds, are on sells right now.
Okay.
So in the realm of interest rates, that means that the MACD of 10-year Treasury note yield or of corporate investment-grade bond yields, which you can get off the Federal Reserve website, those MACDs are above zero. So that's trending to be rising. So we're on a sell. Now, that's an intermediate-term signal. That said, I see a lot of resistance to interest rates getting above 3%. And so for the time being, I think the worst is over. But it is too soon to be bottom fishing in a big way, because interest rates could just as easily make another leg higher later in the year as they could turn back down. So I am not a bond bull.
I see like a triple bottom. Have you seen that on your charts? On TLT, on a weekly chart? I mean, I saw that there was a actual triple bottom.
Well, I mean, if you're following long term, the first bottom was around the election time, 2016, and there was and then there was one late last year, and then now there's this one now, which is really a breakdown, because I think they're a little lower than the first two, right? TLT maybe not so much.
It depends how thick you make that line.
Right. Yeah. Well, no. I mean, you actually touched on something interesting. Is that the 30-year yield hasn't gone up as much as the 10-year yield. So the 10-year yield and IEF, I think IEF is clearly at a new low. 10-year yield is clearly at a new high since 2014. But if you do TLT, where there's some 30-year paper in there, the breakdown is a lot less impressive at this point.
Right. So it's an interesting spot right now. I'm curious to see if you're going to get a positive signal.
I hope we don't, to be honest with you. I mean, I think interest rates are in a long-term uptrend, but I think the leg higher that we've seen in the near term is completed. So I'm expecting interest rates to consolidate here.
All right. Well, thank you so much, Marvin. And how can everybody reach you? How can they get your newsletter?
Yes. Well, www.systemsandforecasts.com, and they can visit our website and sign up for a free trial.
Hear that? Thank you. Thank you so much, Marvin.
Thank you, Stephanie.
Yeah, it's been a lot of fun.